All right, welcome again. We're going to jump right into this. I have a fascinating video, highlight special guest Elon Musk did a interview on the All In podcast which included guys like David Sachs, Chamath, Jason, and I thought it'd be valuable as listeners to catch. It's a full hour, and I shortened it up to like the top 10 minutes that I liked, some of the highlight pieces, and then we're going to dissect some of the things that I thought were really relevant talking about this. So let me go ahead and bring in that audio. Here's from these guys. And
well, I think it does seem like we're headed into a recession here in 2023. The magnitude of that recession is debatable, but I think it's at least a light to moderate recession. Potentially, it's on the order of 2009. So I think it's wise to kind of like prepare for the worst, hope for the best, prepare for the worst. Don't get too adventurous. Like watch out for margin debt. Like I would really advise people to not have margin debt in a volatile stock market, and from a cash standpoint, keep powder dry. You can get some pretty extreme things happening in a down market. Like Brett Johnson, who was the CFO of SpaceX.
Okay, so just to pause for just a second, so you guys are understanding what he's talking about, at least giving a recommendation to stay on margin debt. We're talking about like borrowing to invest. We saw the last spike before the last crash. People were getting so hot and credit was getting so easy that people were literally like running their credit cards to buy stocks, running debt to buy investments, and that's what he's talking about with investment, like being careful with like marginal debt.
Was at Broadcom in 2000, and he said that, and that's a good company making good products. And he said that from peak to trough, I think in less than 12 months, Broadcom went down 97%. So like even if you had a small margin loan there, you got crushed. It subsequently recovered, and I think to much higher levels. But if there's like mass panic in the stock market, then you got to really be careful about margin debt. But I mean, this is just as we know, the economy is cyclic. So we're somewhat overdue for a recession. And my best guess is that, we have sort of stormy times for a year to a year and a half, and then things start to dawn breaks roughly in Q2 24. If I were to get, that's like my best guess. Recessions don't like booms don't last forever, but neither do recessions.
And it's a 14-year boom, so a 6-quarter recession seems like that might actually balance out. The last time it was 4 or 5 quarters, so. It's not easy.
Interest rates have been rising. That increased the cost of the consumer of getting loans, things like that. We've had a stock market correction, really a crash in a lot of growth stocks, software stocks. From where you sit and the data that you see, where do you think the economy is headed right now? Do you think we're in a recession, or is it just a risk? How do you assess our current economic situation?
Well, predicting macroeconomics is always difficult, and one should assign probabilities to these things. Ironically, I did last year. People asked me what I think about the economy. I said, well, I think we might enter a recession in approximately the spring of 2022. Yeah. Now the thing is that recessions are not necessarily a bad thing. I've now been through a few of them, and what tends to happen is if you have a boom that goes on for too long, you get misallocation of capital. It starts raining money on fools, basically. It's like any dumb thing gets money, and I'm sure you've seen a few of those. So at some point it gets just out of control, and you just have a misallocation of human capital, where people are doing things that are silly and not useful to their fellow human beings. And then those companies, there needs to be sort of an economic enema, if you will, to have everyone sort of shift uncomfortably in their seats. So eventually the economic enema does its job. It clears out the pipes, if you will.
Yes.
And sort of the bullshit companies go bankrupt, and the ones that are doing useful products are prosperous. And but there's certainly a lesson here that if one is making useful product and has a company that makes sense, make sure you're not running things too close to the edge from a capital standpoint. They've got some capital reserves to last through irrational times. Because in the past, when there's been a recession, it has gone. It's amazing. It's flipped like a light switch. I mean, David, do you remember this from the PayPal ex-PayPal days when we raised $100 million in March of 2000, and we had the demand was so high, we had people like VCs like just literally without even a term sheet wiring money into our account.
We'll send the term sheet later.
They literally were like sleuth out our bank account number and wire money in, and we're like, where'd this come from? And it's like, oh, so it was like they were just literally fire hosing money in March of 2000, and then in April 2000, the market went into free fall, and it went from raising money was trivial to even good companies could not raise money in a month. So it's just important to bear in mind, like that, PayPal almost went bankrupt in 2000. We came close, but thankfully we'd raised that $100 million in March 2000, without which we'd be game over basically. And we kind of saw it coming. So it's like we got the X Confinity merger done in like 3 weeks and raised $100 million, because we were all like, we see this coming to an end pretty soon. And then a month later, it was like, a nightmare basically. Anyway, so it's just important to make sure if you're a healthy company, you got some capital to get through things, and then what's your costs, and if it is a recession, which more likely than not it is a recession. I'm not saying it is, but it probably is. Then just what's your cash flow and get to positive cash flow as soon as you can. So yeah, but I think we probably are in a recession, and that recession will get worse. But these things pass, and then there will be boom times again.
Okay, so we're hearing from Elon, and he's saying things are not going to get better, right? Things are going to be getting worse. We've got harder times ahead of us. We're likely already in a recession. And mind you, that some of these comments came from a while ago, and some of the data that's come in recently is more profound and is having more impact and leaning, I would say, towards that sentiment more than it was before. So let's finish this, and then I've got some really great feedback on like what you guys can do about it right now.
So there'll probably be some tough going for, I don't know, a year, maybe 12 to 18 months is usually the amount of time that it takes for a correction to happen. I mean, the obvious reason for inflation is that the government printed more money than it had, obviously. So it's like the government can't just have issue checks far in excess of revenue without their inflation. Velocity of money held constant. So unless there's something would change with velocity of money, but it's just if the federal government writes checks, they never bounce. So that is effectively creation of more dollars. And if there are more dollars created, then the increase in the goods and services output of the economy, then you have inflation. Again, velocity of money held constant. But so this is very basic. This is not like super complicated. And if the government could just issue massive amounts of money and have and deficits didn't matter, then why don't we just make the deficit 100 times bigger? Okay, and the answer is you can't, because it will basically turn the dollar into something that is worthless. So and various countries have tried this experiment multiple times. It's not like, oh, I wonder what happens if this is done. Have you seen Venezuela? Like the poor people of Venezuela have been just run roughshod by their government. And so obviously you can't simply create money. The true economy is very important. Like the true economy is the output of goods and services. It's not money. It's literally what is the output of goods and services. Money is simply a way to for us, or anything that you call money, is a way for us to conveniently exchange goods and services without having to engage in barter, and also to shift obligations in time. Those are the two reasons that you have money. This thing called money. It's really a database. Money is an information system for labor allocation and for exchange of goods and services and for translating in time. And the quality of that information is a function of, it's like you can apply information theory to money, and I think it helps explain why one money system is, or why one action is better than another. And so you just like an internet connection, you'd want something that's high bandwidth, low latency and jitter, and is not dropping packets, does not have a lot of errors in the system. And the same is true of money. You want, and really, like you said, what did PayPal really do? That it helped improve the bandwidth, the speed at which money could move. instead of mailing checks back and forth, which amazingly that was what people did in 2000, you could now do real-time exchange of money, and now you could ship your goods immediately instead of mailing a check and waiting for the bank to clear the check. So the ultimate thing that with PayPal, or if it sort of was in the X.com sort of went more less sort of niche payments and more sort of broad financial, would be to simply just intermediate all the heterogeneous COBOL databases out there running on mainframes doing batch processing, and have a single real-time system that was secure and not batch processing. And so it would just be, from an information standpoint, more efficient, and eventually it would, all the batch processing COBOL mainframes operated by the banks would cease to exist. Sure, we don't even need.
Okay, so to just kind of summarize this and not get too much, Elon kind of goes down these, spectrum tunnels, and I can relate to that on some level, but not to the same level. But what he's talking about is like real GDP. The real economy is based on output in goods and services, and that is not keeping up with the amount that we inflated the economy with cash. That frankly didn't keep up, and that's why we had inflation. And then he gave some examples because he helped start PayPal. That's how he got a start. How they almost went bankrupt. What actually led to PayPal doing well, and how they survived the .com crash and then raised $100 million. He went through all of that, and it's really, at the end of the day, solving a problem to create and increase revenue and efficiencies is really the ultimate goal of our economy. That's how the economy is measured. That's how the dollar gains and loses value against other countries. And at the end of the day, that's how we measure success in our dollar denomination. That's how we measure the value of our economy. And right now we're seeing a contraction, no question. And I'm going to talk a little bit about this in a second, but we're also seeing this funneling of cash into the market still. The market is still so high, and there's actually a reasonable explanation for that, that likely is going to shift here in the next quarter, maybe end of quarter this year. So let's just finish this up. There's some great feedback in the last minute and a half of this, and then I'm going to jump into some charts and some references around like what's actually going on, what you can do about it.
Sure. There will be certainly, an economic competition that I think will blow people away when they realize just how competitive they have to be competitive with companies in China. It's very difficult. Tesla is competitive. But Tesla is competitive because we have an awesome team in China that, so Tesla is sort of pretty far out there in terms of work ethic anywhere in the world. So the Tesla work ethic in the US, I think, is substantially greater than any other car company or any large manufacturing company that I'm aware of. Look, I think the point of a company is to produce useful products and services for your fellow human beings. It is not, some political gathering place or a thing where that's the point of the company. I'd say politics and other stuff let's not lose sight of why companies should exist.
I have been guiding our portfolio company CEOs to be at cash flow break even now or extend runway to Q1 2025. And they're
25.
Yes, because I think Elon and I are kind of roughly in the same place we have been for a while, which is like, mid 24 is when the recession ends, and you need to give yourself 2 to 3 quarters of buffer so that you can go and raise around, which takes 1/4 to 2 quarters. And once you start to get escape velocity out of a recession, having money through end of Q1 2025, I think is a minimum requirement. And
Okay. I'm going to pause this because for a lot of us, it's like, whoa, what is Chamath talking about here? And Chamath's a self-made billionaire, used to work with Elon, has some ties in the tech world with Elon in the past. But what he's talking about, like this projection clear past 2024, like companies are not out of this tailwind until the 2025, is the ability to raise funds into or out of an existing recession. So he completely agrees. We're going into a recession. We're not going to see the light at the end of this tunnel until maybe first quarter, second quarter, definitely. He's actually said more recently, I'll show you this. He's actually said more recently, he thinks it's going to be even more prolonged. It might even be further. But the reality is how does this impact you? Well, if you work for a company that is a startup, if you work for a company that was given money from the public and you are not making money right now, you are not at least at break even or have the runway in cash to get to 2025, you probably should start considering working for a company that does. Now, that doesn't mean you won't be able to transition or you won't be able to make those changes, but the prediction is that those companies are not going to last. Why? Because they are not going to be able to raise cash in the next year to 2 years. It just won't be feasible for the company that is a startup to survive this unless they have so much runway to have, and runway being cash in a bank to pay employee expenses, get the product built so that they're actually creating cash for the business. So that would be my first warning. The second is if you're invested in a company like this might be a huge red flag for you to start considering how you're holding your capital in these type of companies. So I'd be looking at like stocks, pink slips, right? If you're trading these like, really high risk entities, or you own some, stocks or maybe some private investments in like startups, if they don't have cash that's going to hold them till 2025, it's kind of a done deal for them. They're just burning the midnight oil, so to speak. And so that's what they're talking about here.
Of the companies that I think were the most precariously positioned, there was 5 of them that got their acts together and really did it. But these are all CEOs of companies that, if you said them, you would know some of them.
Yeah, I said Stan Druckenmiller. He, as you recall, last year he predicted that inflation would be lasting. This was in spring of 2021 when transitory was the word of the day. This year, he predicted the bear market rally we had in July and August. And I remember back at the Coaching Summit in May, there were around that time, he was interviewed and he basically was saying that as soon as there was a bear market rally over the summer, that he would then put a short position on. I don't know if he actually did that, but he said he's going to do that. And then it turns out that the summer rally that we had was a dead cat bounce. So he was right about that. And now he is predicting a hard landing in 2023 with a deeper recession than many expect. So sadly, I suspect he may be right yet again.
Well, all right, lots to go over there. Before we do, though, a lot of you guys may want to get back into this at some point. And so I'm going to do something for you really quick. I want to bring this up. Let's see, how do I want to do this? Let's do this. I'm going to bring this up really quick, just so that it's not a huge distraction from what we're doing. But I'm going to show you guys this really fast. Here are some of my social media plugs. So here, if you guys have your phones and you're watching this on any of the channels that I'm live on right now, here's the way that you can actually go to my YouTube. The recording is going to be here on my YouTube channel. I'll show this really quick also. But on my channel, you can subscribe by going here. On the top right is typically where the subscribe is. Obviously, I'm logged in right now, so you're not going to see that. But if we weren't logged in, this is what you would see. Just close this really quick. There we go. Much better. But this is what you'd see. And just to give you a sense of some of the stuff that I'm going over here, I've just started this podcast. It's so far been a huge hit. I'm getting lots of feedback, lots of criticism. And I enjoy the criticism, guys. Obviously, if you think I'm wrong about something, call me out on it. But I've got lots of stuff where we cover everything from real estate, stocks, market trends, inflation, obviously dollar denominating topics like currency trading. You guys, a lot of you know that that's kind of where I got my start, was trading the Forex market. I do lots of that. And every week I'm putting out data, hot tips, hot topics, even stuff that are happening the day of. I'm talking a lot about AI right now, the overinvestment that's happening in some companies, the underinvestment in some companies. So there's just lots of good data here. You can follow me on here. You can also follow me on my TikTok channel, which I just started, getting a lot of traction there. You can scan this with your phone. It'll take you to my TikTok area. Place where this exists is here. I'm getting really good at doing this. And here I do mostly shorts. So these are like day in person, like daily shorts. And so you can follow me on here also, where I give tips. If there's like a recent announcement or something that happened that's relevant, I like to do little highlight reels. And you can see that I just started this, but starting to get a good following. and significant. I've had, handful of my videos go pretty insanely viral just in the short time that I've been running this. So back to where we were talking about. Elon Musk obviously, has a lot of respect from the public. Tesla, SpaceX being some of the companies he started. Someone that I would say is a industrial or a financial thought leader. He's a venture capitalist. He's a CEO. He's someone that people really admire when it comes to the market. And one of the things that I've noticed recently that we're going to talk about is this hard landing. Like, what is going on? Like, when is the market going to finally bottom out? Because it's like, if you look at the stock market, you look at the S&P 500, and we're going to talk about this, by the way. If you look at the S&P 500 right now, it makes no sense. It's like things feel tighter, interest rates are higher, people are a lot more skeptical. There's a lot more kind of like, I would say it's kind of this eerie silence in the market, yet the S&P 500 is hitting all-time highs. And so like, how in the world is that happening? Why is that happening? And before we go too much into that, I really want you guys to listen to this thing from Chamath, one of my favorite guys I follow on the All In podcast. And I think you're going to get a lot of value. This is a really short clip about how, and this just came out, by the way, this came out last week from Chamath. So that last video was like end of last quarter, early this quarter. So that was like the prediction. There's a lot that's happened over the last 4 to 5 months. This just came out last month and has actually shifted some of the views that Chamath had on that last video. And I would say is really great input on what Elon said about 5 months ago. So let me bring this up so you guys can see it. I put a little short clip on this together for you. All right, here we go.
Still on the sidelines.
What have I said like a broken record? Rates are going to be higher than you want, and they're going to be around for longer than you like. And now Powell is basically telling you the same thing. So we're almost at the end of, I think, the bottoming, though. I don't agree with Druckenmiller. I think he's wrong.
On which part? That there's to be a hard landing.
Now, you remember, Druckenmiller was the one they were just quoting before that was right about the drop last year. Druckenmiller is predicting a hard landing meaning that like rates come down, we actually start to see massive deflationary movements in the market to where we can start to add QE, we can start dropping interest rates back down. Chamath is actually disagreeing with that. Now, granted, Duncan Miller might have changed his perception since that prediction that was early this year. But what Chamath is about to say, I think, is really insightful. I would happen to agree with what he's saying, and it's not good news. It's like buckle up for a long time.
Yeah. And the reason there's not going to be a hard landing is you just saw China today basically say we're going to start to rip in trillions of dollars. They're going to stimulate the economy. Can't have a hard landing when China's printing trillions of dollars. Not possible.
Okay, so pause. This is like breaking news. When I heard this last week, it blew my mind. And so I actually did some research, and we're not talking about it. Legacy news in the US is not talking about how China is spending doing trillions of dollars in quantitative easement. And so I went on a hunt looking for this. The only place I could find that was on somewhat US media was this article on Forbes. Everything else is Japan news, China news. No one else is talking about this in the US. Let me just show you this article really quick. Fascinating article, by the way, and what Chamath had to say. But China is gearing up to rip in trillions of dollars. They are doing QE. So they are quantitative easing, which means that they are printing dollars to help stimulate their economy because things are not going well. So what does QE mean? And by the way, this article, the only reason this article got created was this was kind of look at what they put right after the price of Bitcoin, Ethereum, blah, blah, blah. Like they're talking about a swing. They're basically saying, well, if China is going to be printing more money, this actually should be good for alternative currencies that don't print. Bitcoin being one of them, right? Ethereum being one of them. So this is making a case for Bitcoin and Ethereum. I'm not making that case. I actually think that there's a longer winter coming in Bitcoin, and we can talk about that a little bit later. But China is gearing up to print trillions of dollars. And if China does that, I just want you to hear me on this. If China does that, we are so directly tied to China. Like, look at the products. In fact, I just had something shipped to my house, and everywhere on it says made in China. Well, if it costs China more money to make it because they've gone through inflation, let's say China has a 10% inflation in the next year, the cost for them to make goods goes up. Well, how does that affect us? Well, when we ship in all of their cost of goods, those costs of goods are also going to be more expensive, which does what for our inflation? Does inflation go up or down? It's going to go up. If the cost of goods cost more from China, that's not deflation, that's inflation. And if China is gearing up to rip in trillions of dollars over the next couple of years, that's only going to make their price of goods go up, which is in turn going to cause our price of goods to go up as well. Here, what the rest of Chamath's statement is. He does a really good job summing this up.
So I think that what Powell was forecasting is that if China starts to basically turn on the money printer and go through a huge spate of quantitative easing, it's going to just inflate everything because they're just such a critical artery to the world economy. And so you just have to get prepared for rates just being sticky and inflation being sticky. And I think that that's probably the most reasonable base case for the rest of the decade.
Rest of the decade, 7 more years.
Yeah. And so in that environment, the problem is that now you have the 7 or 8 most valuable tech stocks priced to perfection yet again. If you look at their enterprise value over their net income, these things are trading at astronomical yields that are less than half of the 2-year note and now approaching sometimes less than half of the 10-year note. Government bonds. That makes no sense. And if you subtract out those 7 or 8 biggest companies in the S&P 500, the S&P has not been a great asset. So I think the equal weighted index, Brad, you probably know the exact number. The equal weighted index is just shit. So what does all this mean? I think it means that people are psychologically exhausted with having lost money. They are psychologically wanting to will the market up. They want to psychologically believe whatever will allow them to influence rates getting cut. But I think the most reasonable bear case is rates aren't getting cut, and whatever hope you had of rates getting cut just went out the window today because there is no world in which you cut rates when China's going to print $1 trillion. All
right, lots to cover there. So we're going to talk about this S&P weighted index. Chamath also talked about the top 7 stocks in the S&P 500. Now they're priced to perfection, and how when you compare the yield of these to a 2-year bond, to a 10-year bond, their yields are half that amount based on the market cap, based on the amount of money that's currently coming out from a PE ratio, right? The actual value of the stock. So we've got this hyperinflated market. We've got all this cash that went dumping into the top 7 stocks in the S&P 500, not because of value, but because of like potential growth gains or perception gains. And they're underperforming the bond market, which makes no sense. Why are people investing in these stocks and not in the bond market? And it's like Chamath said, and I'd have to agree, it's really a psychological disease. It's a psychological problem. So I'm not going to have you take mine or Chamath's language on this or just my perception of this. I want to give you some data that's going to argue these facts and have you see for yourself if you agree or not. And either way, it's your job to do that anyways. It's not your job to take mine or Chamath's information and start trading it. You've got to make an educated decision on your own, but most people don't know where to look. And so I'm going to provide that right now. So here's what's next. And I know we're running out of time. Did not anticipate this taking as long to get through this first step, but let's talk about inflation. So if you are experiencing inflation, you understand what inflation is, and you're like, this sucks. I've got a bunch of cash. or I've got a bunch of money in the market. It seems like it's at an all-time high. Is now the time to pull it out? Well, I don't want to pull it out because if I have the money sitting in a bank account, I start losing to inflation, right? I got to at least keep up with that number. So what do you do during inflation? If Chamath is right, if we're going to have stagflation for the next 7 years, for the rest of the decade, and Jerome Powell is going to be constantly just holding the rate over a quarter point increase here or there. And we know there's 2 more increases coming the rest of the year. Jerome Powell's been very clear about that, even though we had a pause in rates last month, or it was actually a couple of weeks ago. What do you do with that? Well, you own stuff. Stuff moves with inflation, and not the kind of stuff, I can't tell you how much crap I have in this house where you buy something and it just immediately depreciates in value. Not that kind of stuff. Not technology, not like, computers, like real stuff, like land or gold and silver. Or, and I'm going to do this really fun one, and this is such a huge tip for investors, specifically our audience, I think would get a ton out of this: bonds. Specifically I bonds. And I want to share this with you. If you haven't heard of what an I bond is, today is your lucky day. I'm probably giving you one of the best tips to help you navigate inflation for a small dollar amount. It's not, you can't put a ton of money in these things, but if you've got $15,000 sitting around somewhere, an I bond may be your best bet because it actually protects you against inflation. It's a bond linked to inflation, and if inflation goes up, so does your bond. So it protects you. It's a government issued, I don't know if you'd call it a security, but it's a government issued bond or note that is tied to inflation to protect you from just in case inflation goes up, and it's limited to $15,000 a year. So I'm going to show you guys this. Investopedia does a great job doing this. Actually, let me go straight to the article. This will be easier. There we go. And Investopedia talks about this as hedge your bets with inflation index bonds, and that's what we call an I bond. And an I bond, so when inflation happens, inflation can be the dampening effect on fixed income investments and reducing their purchasing power and cutting their real returns over time, right? So if you just have money in cash and inflation goes up, your cash is worth less. A candy bar now costs $1.50, not $1. Gas costs $4, not $2, right? That's all inflation. And so just having your cash sit there is a lose proposition. This happens even if inflation rate is relatively low. Even at 2%, this is true. Which is typically where we have it at. If you have a portfolio that returns 9% and the inflation rate is 3%, then your real return is around 6%. Inflation index linked bonds can help you hedge against inflation risk because they increase in value during inflationary periods. So some of the takeaways I'm hoping you're getting from this is inflation index linked bonds can help you hedge against inflation risk because they increase in their value during inflationary periods. And this is what Chamath was talking about. It just makes no sense that people are putting all their money in these stocks when you can get, from a value proposition, a better return from bonds right now, a better return. And it's the same thing with real estate, but real estate makes a lot more sense. People are, and we're going to talk about that also, but people aren't investing in real estate anymore because it just, all you have to do is a simple napkin formula on like, am I going to make money on this investment or not? And because interest rates are so high, most of the stuff isn't panning out. So I bonds, go look up I bonds. You are limited, and I think it shows it here. Let me see if the amount is on here. It's not, but I made a note here. So let me just give you guys the scoop on I bonds, and then you can look them up. You go directly to the Fed site to purchase these. But this is kind of the premise of what you can do and get out of an I bond. Individual purchase limits for an I bond are $15,000 per calendar year, $10,000 worth of electronic I bonds, and $5,000 of paper. So you can do a combination of 10 and 5 if you have that money sitting around and you're not putting it active out in the market, or maybe you think the market's too high and you want to pull some money out. I bonds, I think, and this is my personal opinion, obviously do your own homework on this, but I think are a very safe way to protect your money against inflation. And, you know, it's not a ton of money. You know, if you've got hundreds of thousands of dollars, this isn't going to cover you. But $15,000 for a lot of people is great. And it has this inflationary index that it actually goes up. The value of it goes up with inflation. And it performs better in inflation than a typical treasury note or a like a 2-year or a 10-year note. Now, having said that, if you've got more than $15,000, we talked about like what else could you be investing in? Treasury notes are actually a great place to do that. And this is what Chamath was talking about. Let me show you the current yield on treasury notes. Current treasury notes, 2-year treasury notes right now are 4.76%. 4.76. Now, a lot of you guys are going, well, I'll just put my money in a CD, or I'll just put my money in a money market account. You know, that's fine. I get it. I get like our laziness to just go to the bank that we trust to do this with. Let me tell you what they're doing with your money. They're doing this with your money. They're already doing this, but then they get the leverage of the trade, you know, and they're lending, you know, they're doing car loans, they're doing some home loans still. That's happening. So they are charging a higher rate. They're making the difference in the percent, but they're also buying bonds with your money when you put in money for a CD, money for a money market account. And so you go, well, how am I getting 4.5% or 4, in some cases, even 3/4 when the 2-year bond is giving 4.7? That's not much of a gap. Well, they only need a couple points to be profitable on this, right? But let me tell you where the real carrot is. If you buy a 2-year treasury, the benefit is if you buy it now at, you know, let's say you get a 4.7% return on the bond at the expiration, regardless of how it's trading. Let's say that it goes to 2%. Your 4.7% you'll get at the expiration. You'll get it at the end of the term, regardless of what the market's trading at. But here are some of the benefits. Let's say the market does start dropping. Let's say it goes down to 3% or to 2%. And as things get better, by the way, that's what happens. The projected rate starts to drop because everyone's projecting what the future is going to be, and the rate starts to come down. So right now, we're almost back into all-time highs on the 2-year treasury note. It went up into 5 in March last year, or excuse me, March of this year, it hit 5%. We're almost there again. Buying bonds may be the play here, but let me show you why. There's a formula that's known to all major bond investors and banks that most of the public doesn't know. And I would call it even a hidden secret. It's hard to find. It's hard to even find this stuff online, but I found a place that actually published it. So let me share this with you. I want to show you the correlation of what happens to your bond once you own it and rates start to drop. Like, does the value go up? Could I trade it for more? What actually happens? And so I'm going to show you this, and it's fascinating. The correlation when rates drop, if you own a bond at a higher price, it actually benefits you, and it's worth more than it was worth when you bought it. It's worth more than if you hold it to the end. And when you understand this, it makes a ton of sense. Fidelity did an article on this, and I'm going to show you the correlation. It was like a full level documentation that they put out. And I think they do this to kind of help their investors understand, like, this is why we invest in bonds. This is what your money will do in bonds. When you invest in us, this is how we understand this. But so here's kind of like the full duration, understanding the relationship between bond prices and interest rates. Obviously, you can come back on. You can get the domain on here. Let me click on it so you guys can see the whole link. But there it is. You can Google search this topic. It'll also give you this article. But here's the correlation. Of course, duration works both ways also. So if rates go up higher, this will be the opposite. But worst case scenario, you can hold it to the 2-year end and get your return. But if interest rates were to fall, let's say you bought it at 5% or you bought it at 4.7%. If the value were to fall, the value of the bond with the longer duration would rise more than the bond with the shorter duration. So if you had a 10-year, the value would be worth even more, but 10 years are at like almost 1% lower than the 2-year right now. But the longer the duration, the better. Therefore, in our example above, if interest rates were to fall by 1% on a 10-year bond, not a 2, but a 10 because it's longer, with a duration of just under 9 years, so you're like within that first set, would rise in value approximately 9%. So let me say it again. Therefore, in the example above, and this is let me see if they've got an example here. Yeah, it's not spelled out really well. But if you were to buy a 10-year bond at a certain rate, and the rate was to drop 1%, the 10-year bond with a duration of just under 9 years would rise in value approximately 9%. You would gain 9% in that value. If the rates were to fall 2%, the bond value would rise approximately 18%. So if things were to go back to normal, let's just say, and like Chamath has said, Elon's even said, these windows of recessions are never permanent. We always go back into a growth phase. It's just what happens. We could predict that that's likely. The world's not coming to an end, right? But if we were to get into a high bond, a good yield, worst case scenario, we hold it all the way to the end, we get our percentage return. Best case scenario, rates start to drop, things start to come down, and for every 1% that it drops, we get about an 8, they say 9%, but it's about 8 to 10% increase in the bond value. So you could go on the market and trade it for more on a 2% drop, which would bring us back to kind of that norm. So if we were to go back into norms around like how the treasury is lending, like what the values would be, that would be an 18% increase in the value of that bond. Why? Because banks are forced to buy bonds. Why? Because funds are forced to buy bonds. Why? Because insurance companies are forced to buy bonds. They're forced to have a certain level of their portfolio in bonds. So what kind of bond do you think they're going to want? One that's at 2% or one that's at 5%? And how much of a premium would they pay to have a bond that goes the next 8 years at 5% versus one that's going to be 2%? They're going to pay a premium for that. And that's the correlation of buying bonds at the peak of the market. That's why Chamath says this makes no effing sense. Like, this is crazy. I mean, it's crazy to me that these legacy stocks, the top 7 stocks, the value of return is less than half of the 2-year and a 10-year return on a bond. Why aren't people moving to bonds? And frankly, it doesn't make sense. There's something psychological going on. And if you guys know the rules of trading, right? You sell when people are fanatic about a market. You sell when it doesn't make sense anymore. You sell when people are financing to get in. You buy when there's blood on the streets. You buy when there's panic. You buy when there's fear. And frankly, the market is complacent. It is radically complacent. Let me show you this. We are getting close on time, but I have a lot of other things to go over. So we talked about the treasury note and starting bond values, went through that. Okay, we can take a little bit of a breath. So that's a good tip. I also like gold. I also like silver. There's kind of this unique correlation that happens between gold and silver when we actually go into recessions. If you look at a chart, last time we went into a recession, silver hit its all-time high, gold hit its all-time high. We've obviously come into some of that new territory. Silver has not gone back into that. We were seeing $60 silver prices when the last recession was happening. Why? Because people freak out. And so they buy things like gold and silver when things get hard and look really bad and grim. And that's actually when you want to be selling your gold and silver. So you don't want to wait for that. You want to be buying it now. And then when things get bad, sell off your gold and silver if that's something you're thinking about doing. We're going to transition just a little bit, but it reiterates a lot of the things we've been talking about. And I'm going to take a turn into the real estate market. I know that we're running out of time here. So one of the things I want to talk to you about the real estate market and some of the recent changes that have happened within the last even 30 days. One is home purchases by investors that fell 48.6% in the first quarter this year. And this was according to Redfin. I'm going to bring this up really quick so you can see it for yourself. I'm not making this stuff up, guys. This is real, and these are on the real estate websites. I have people on my social media that are like, you have no right to talk about this. I'm like, I'm not. I'm just pointing to Redfin. Like, they're the authority on this topic. If there's anyone who is going to have the info. It's going to be them. They have all the data, right? So this isn't me saying this. This is Redfin. And Redfin came out with this in May. So this was the end of last month because they had just gotten the data. And they said investor home purchases fell a record 49% year over year in the first quarter. And this is the highest we've seen it since the 40% drop. I think it was back in, what was it, 2020. Yeah, so you can see 2008, we saw this drop, and it wasn't even at 49% last quarter. So fourth quarter 2022, we were right in that 2008 territory where investors were like, we're not interested in the market anymore. And now it's at 49%, which is the highest it's been since, since as far back as we can see. What does this mean? Why is this happening? Well, it just doesn't pencil out anymore. If you were to buy a piece of real estate at the existing interest rate, the rent that you would get for it just doesn't yield returns. It doesn't yield cash. So it just doesn't make sense to borrow money, because a lot of people think investors are just cash investors. Everything that these investors are buying is just with cash. No, everything's financed, everything's leveraged. There are very few investors that are all 100% cash in the real estate market. Now, if you had that much cash, you could do that. This may be a good time to get in on certain projects, but to finance something just doesn't make sense. And that's why we're having the dropout, and it's escalating. This is not dropping. This is escalating. Investors are just completely getting out because things don't make sense at all. Having said that, there's some additional data that I think is important to know. If you are looking to buy or move or sell, I think it's important to understand your demographic. So those are national numbers, but there are all these kind of weird things happening state to state. And I think it's really valuable for you to know what's going on in your state. And according to Go Banking rates, and actually KSL, our local state here in Utah, did an article on this also, talks about the 18 states that it's actually cheaper to build than it is to buy. So why would I go out and buy a home that already exists, that's 10 years old in these 18 states, when I could build for less, and not just a little, significantly less? Look at this, guys. New York, total building cost for the average home, $524, median, the difference in cost, $11,000. So not much. If you're in New York, it's like, yeah, I could buy or I could build. I'd probably just buy so I don't have to wait, right? As long as the home's nice and in good condition. Tennessee, $13,000 difference. Georgia, $30,000. North Carolina, $32,000. If you're in Oregon, $43,000. So at this point, it's like, okay, that's enough money that I might build and get something brand new and wait a little bit rather than buying something on the existing market. Texas, $51,000 difference. Massachusetts, $53,000. Washington, $66,000. It's like, whoa, okay, now we're getting into territory. It's like, it would never make sense. Even if I'm not an investor, to buy, I would definitely build. Idaho, $70,000. Florida, $76,000. And this is on the mean. If you're buying a high-end home or a home that's more than this, the gap's even bigger. It's even cheaper to build than to buy. Montana, $84,000. Maryland, $95,000. Delaware, $96,000. So now we're getting to almost $100,000 territory. Cheaper to build than to buy. Why? Because inflation happened, and we're seeing all these deflationary measures where lumber costs are coming down, steel costs are coming down, cement costs are coming down, labor costs are starting to come down. Utah, $97,000. That's my state, by the way. Colorado, $108,000. California, $205,000. Guys, wake up. If you're in Hawaii or California, do not buy, build. It's like an enormous cost difference. Hawaii is almost $500,000. I mean, that would be a great place to have to move to, right? I'm probably not speaking to most of my audience, but if you're in California, there's no logical reason to buy something existing unless you're pressured to do so. I heard some recent data, by the way, for a lot of you that are being forced to move back to California. There are a lot of companies after this exodus of like, hey, let's go work from home. We're going to try this work from home thing. A lot of companies are forcing people to come back, even after they made a declaration that they were never going to do that, never come back. And now they're saying, no, now we are. You have to go back to work. And most of these people left the state. And now they're forcing them to come back into the state of California. And you saw what's going on. It's like, well, I have to buy now. I can't, I guess I could rent and then wait 8 months. But a lot of these people are doing this going, should I buy or should I build? It's very clear. I would definitely hold off on buying, and I would build. Here's some other data on the real estate market. I'm actually seeing a turn. I personally think that we're going to see a correction. We've already seen a massive correction in the mean home in the market. I have people on social media saying the dumbest things, and I get it. I used to be there. I used to be a highly uneducated troll that would go out on the market and just say whatever emotionally I felt like. But the reality is the market has already corrected. What a lot of these trolls and people that think I'm crazy don't know is nationally, the market has already come down. We've already seen a national decrease in home prices. And if you're in one of those hot markets, it's likely going to drop even more. In fact, some of the guys I follow are watching states like California, Arizona, Florida, New York, where they're saying the costs are going to get worse. They got overheated. The costs are going to drop even more in these states. And they're already seeing it. They're already seeing increases in foreclosures. In fact, we're going to talk about that in just a second. They're seeing increases in short sales, people not being able to make their payments, and frankly, rent values. Homes aren't getting rented because they're sitting on a price that people aren't willing to pay. We are getting really close to the end here, but let me show you this. This just came in last week. This is from Atom, which is another real estate site that I like to visit for data, where U.S. foreclosure activity sees a spike in May 2023. A lot of this has to do with the moratoriums around foreclosing and getting people out of their homes over the pandemic. And now all states have lifted that. We're finally in a territory where people aren't staying in their houses for free and the landlords are covering the bill. We had a completed foreclosure increase. So that means that the foreclosure got completed by 38% in May and an overall increase of 4% in the last month. Now, if you keep reading through this, default notices, scheduled auctions, and bank repossessions are up 7% a month ago, 14% from a year ago. These things are just starting. They're just starting to happen. And let me tell you the one thing that I think the whole thing is hinging on, like if there was this little tipping point that it all hinges on, that I would be watching like a hawk, it's unemployment rates. Unemployment rates are at an all-time low. Have we seen them slowly starting to tick up? Yes. Is the Fed's happy about that? Yes. That's why we did a pause, plus the China thing that they're aware of, where they're going to be going through inflation. We're looking at all of that. But all of this hinges on unemployment. And with all the data and all the things that you just heard today, do you think unemployment's going to get better or worse? Well, clearly, I mean, my prediction would be it's going to get worse. And I think everything is hinging on that. If we had just a 1% additional increase in unemployment, this whole the house of cards falls. That's what happens. And it's all, there's just this one card that's really stable right now called unemployment. The moment that comes out, just by 1%, this whole deck falls out because now those people can't pay for their homes. And it's a very small percentage. But that 1% is affecting everything. It's affecting the stock market staying up. It's affecting the real estate market staying up. Like all markets, I would say, are hinging on that one thing. So I would, every time the unemployment number comes out for the next year, that would be like my number one indicator of like when things are going to flip, and they're going to flip hard. All right, let me look at my notes here really quick, see if there's anything else I wanted to cover before we end here. Oh yeah, we have to do this. I've got 1 minute, we'll go just a couple minutes over, but I have to show you guys this. This is what Chamath was talking about with the weighted index versus the S&P 500 actual index. What does that mean, a weighted index? Well, the weighted index is when you take all of the stocks and you weight them evenly and you go, okay, what's the actual percentage return if you take every 500 stocks and you weigh them out versus the top 10? And like Chamath said, very boldly, he says the weighted index is shit. And frankly, it is. the top 10 stocks, it's actually 7, but the top 10 stocks in the S&P 500 is what's been driving this bull run. The other 490 are actually not performing that well. And here is a great website from Investco that goes through this, talks about just from 2017 to Q1 of 2023, there has been a 7.4% increase in that top 10 companies. That means that the money just moved around. It just moved from one thing to the other. And when you look at bond rates and the return of bond rates, and you look at those top 10 companies and what their value is, you look at the PE ratio and you look at the value and you see like, how much cash am I going to actually get back from these? Some of them actually don't even have a cash rate. They actually don't give cash back to their investors. It makes no sense. There's no real value in it. And so when you look at the weighted index of the S&P 500 versus this top 10, here's what's actually going on. I watched a video with Warren Buffett and Charlie Munger's, their most recent interview they did together, and they actually hit the nail right on the head. They said, people are being dumb. Investors are being idiotic. And when he said this, he wasn't talking about you. He wasn't talking about guys like me. He was talking about everyday investors. He was talking about hedge funds, not everyday investors, excuse me. He was talking about hedge funds. And let me tell you the dilemma that they also talked about with hedge funds. You give your money to a fund. Probably everyone in this room, whether it's through your 401k or, a private investment placement with a hedge fund, you've got money out there, right? On some degree, or someone who does. Well, what does a hedge fund have to do, or it upsets their investors? Every month, they want to see that you're making money. Every quarter, they want to see a return, and they want that return to be positive. So when you give your money to a hedge fund, a mutual fund, someone who's managing your funds, what do they have to do? They have to go out and spend it. So all this money from the pandemic, all this cash that came in, all this extra M2 supply that happened, people got this load of cash. They handed it to a hedge fund manager. They can't sit on it. A lot of them are just as smart as I am. And they're going, well, the market doesn't make any sense, but I have no choice. So I'm going to put the money in my best bets, the best things I can possibly think of. And so cash just went flowing in to these top 10 companies. A lot of it has to do with the AI run, but that's what they had to do. And so does that mean it's smart? Does that mean that the return's going to be good? No, it doesn't. Does it mean that they're doing the right thing? No. Charlie Munger and Warren Buffett said they're dumb. This is the dumbest thing. It's like they're saying, I'm not doing that. These guys clearly are. But we kind of twisted their arms behind their back. This run up, we kind of forced. And it has to do with the structure of how we misallocate our own resources, how we give it to the hands of someone else. And this really builds a case, a strong case, especially when this crashes, when this starts to really hurt people, to be more financially solvent and financially responsible yourself. And so we're going to see it happen in 2008. People hated hedge funds in 2008. People hated the people they gave their money to. They knew they could have acted and done things better, but they didn't. Why? Because they kind of have this weird agreement with their customers to always be in the market, always be fighting for the best return and competing with everyone else in that way. Where really sometimes the best thing to do is to pull your money out. Sometimes the best thing to do, like Chamath pointed to, Elon pointed to, the references that I've made with Charlie Munger, Warren Buffett, it might be, it's boring, it's not exciting, but it might be the best thing to do to put your money in bonds right now. It might. It's not a great return. You're not going to see 12%, right? You might be just kind of floating, barely keeping up with inflation. But what's the risk? Well, if we're at an all-time high, you just can't run in those circumstances forever. We've been in a bull market for longer than, we're almost going into 2 decades. Since 2008, guys, almost 15 years, 14 years bull market. It just can't do this forever. And so is there going to be a recession? Yes. Will there be a correction? There has to be. Like Elon said, there has to be a correction in the market. There's a ton of money that even The dumb, bad actors who aren't making money are still surviving. They're still operating on funds. And at some point, there has to be a contraction. Like they say, when the tide goes out is when you actually see people with their pants down. It's a really great metaphor, but that's what's required. We need the tide to go out so we can start to see the good companies from the bad companies. We can see the good ideas versus the bad ideas. And the good ideas will always survive. They will always move into the next market. And the bad ones, frankly, shouldn't. And rightfully so. And it might be that we've just nursed a lot of bad ideas for too long. And we're seeing the results of that with all this additional money supply in the market. All right, guys. That is it. We have wrapped up this hour. Thank you so much for joining me. Again, follow me on my podcast, on the Market Pulse podcast on YouTube. If you haven't already, I do a lot of midweek updates. I do shorts throughout the week. And then every Friday we do this. I've got some guests coming on next month. Every second Friday, we do a full forecast on the real estate market because I get that data faster and sooner than most of the news. And I report on it about 2 weeks before the news actually starts reporting on. So if you want to be in the front of that, that's every second Friday. But again, thanks for being here. Matthew Pohl, your host, Market Pulse podcast. And you guys have a great weekend. We'll see you next Friday, same time, same place. Thank you.